Welcome back, everyone. Super excited to have you here. I'm Lucas Poles, the managing partner of Pegasus Angel Accelerator, for another episode of VC Unfiltered. Today, we're taking you behind the scenes of an event that Tech Coast Angels, one of the largest angel networks, threw here a couple weeks ago. We've got a bunch of a great panel of venture capitalists that came and gave unfiltered advice to some of the investors. And so, take a listen.
Good morning. We have a great session for you. It's about early stage investment. If I can ask all of you to maybe give us a little bit overview of your firm, types of technology or deals that you're interested in, the stage of companies you invest.
John Tabis from M13. There's the Core Fund, which is a roughly $400 million Series A focused fund. About 80% of the deals will be leading at Series A, 10-20% at sort of the seed. Actually run the venture studio within the fund. So we're pre-seed as early as you can get, an idea and a piece of paper. Our deals are typically $250 to $500K first money in, alongside of some angel investors, maybe another pre-seed fund. We aim to launch 3 to 4 companies a year. I've been with M13 for about a year and a half and joined formally about a year ago. Previous to that, founded the Books Company, which is an online flower gifting company. It's about $100 million in top line, break even EBITDA today. Have a wonderful CEO running that, and I spent some time as chairman of the board there as well.
My name is Laurent. I'm a partner with JLL Spark. We are a global prop tech, real estate tech investor, investing in seed through Series B. Check sizes $2 to $10 million. We're looking at all things within the built world, so everything from construction tech to property management, the financial tech sector. Within our space, smart buildings and a handful of other things, sustainability, and recently a lot more in the data center space. Previous to that, I managed a firm called Luma Launch, early stage seed fund here in LA.
My name is Howard Ko. I'm a partner with Morpheus Ventures. We're based in LA, actually just across the hill here in Sherman Oaks. We typically write between 1 to 10 million, $3 to $7 million is straight down the fairway. So we do seed, Series A, Series B. More often than not, we're co-leading or leading or co-leading Series A investments. We're vertical agnostic, so we'll invest all the way from enterprise software, prop tech, fintech, AI, machine learning, obviously, all the way through to deeper tech. So our deeper tech portfolio kind of includes quantum computing, robotics, space-based related type investments.
Good morning. My name is Rick Smith, founder, general partner at Crosscut Ventures. We're a LA-based seed fund. We're on Fund 5. We have about $330 million under management. For most of those 16 years we've been around, we've been a generalist fund. The last couple of years, we've been more focused on climate tech and frontier tech, doing some fun, cool stuff there. But we're still investing across the board, but most of our investments these days are going to be in those 2 categories.
Whether it's within the past 12 months or maybe share with us a deal that you wish you had invested and you didn't, and maybe a deal that you're very happy you did not invest in.
So and it really is, it's a few years ago now, but I always think about this deal. It's called Clutter. I don't know if anyone here was invested in Clutter. It's a deal we looked at. We thought it was going to be really big, but we just couldn't get our arms around it. Sequoia came in after us, like a bunch of people came in, and it's one of those deals I see the trucks going down the road all the time, like, damn it, why did we invest in Clutter? And then I found out last year, after all these money raises, the investors got wiped out, okay? And it really just reminds me that, in this business, and everyone in here is an investor, I assume, it's a tough business. And even though I've been around for a little bit, I still was sort of counting my losses just based on rounds raised, rather than, actual outcome for the company. And I think I was talking about Annie Duke's book, Thinking in Bets, which I think is great. But one of the things she says is, don't necessarily judge your investments by how things turn out, although ultimately that's how we're judged, but it really is your process. And did we do our process right on Clutter? Yeah, we did. It just wasn't going to be a deal for us. It would take more capital and all that kind of stuff. So it just wasn't the right deal at the time. So that's one of those deals I wish I'd done and now glad I didn't do, I guess, at the same time. But a more recent deal we did was a company called Umbra, which is kind of our first deal in the frontier tech space. It's a satellite that just has better ability to take images than anything out there, much cheaper through clouds at night. A company that's going from 2 to 30 to 100 million in revenue over the last couple of years. So of course, my favorite is one that's generating the most revenue, but I've never seen that kind of growth. And so it has emboldened us to take a few more chances like that. I will say the thing we have to keep reminding ourselves is we need to take big chances. This is that kind of game. And when we take the smaller plays, it feels safer, but it just doesn't produce the returns.
I think maybe it's similar to Rick. I think you need a bit of time in order to be able to see something in retrospect to see if it works or not. I think in 12 months might be a little short. Maybe I'll take mine for a few years back, Bird, since we, especially in town, right? I still remember got introduced to the team. It was just like first when we first looked at it, it was 60 million, then it was 100, then it was $1 billion, then it was 2 billion, right? And I still remember valuation wise, not so much revenue, but valuation wise. And at the time, like, wow, like, did we miss the boat here, right? But we just couldn't. At least I couldn't get my arms around the unit economics of the business model itself, and the market they were serving. But man, when it just kept on going up and up and up and up, it certainly didn't feel very good. Passing on that deal. In retrospect, like, now that what's happened with the company and whatnot, hindsight's always 20/20, yep. Right? To some degree, you're like, yeah, like I knew that would have happened, but it really did not feel very good. When you could have got a 20x markup, like literally within 18 months, I think, kind of at the time. So that was one. I think one of the more interesting deals we did recently, and still at Rick, is that we took a bit of a longer term view and took a bit of a swing. And to some extent, I think we always have this discussion internally about should we be taking those swings that is kind of binary in nature, or hey, these companies, that's a good company that can hit 10x, 15x, 20x reasonable path. So we did a company in quantum computing that was doing room temperature quantum computing chips. And the thought process there was, look, if you can actually pull it off, the market should be pretty massive kind of for that, because the current quantum computing, I don't know if anybody knows, but you have to be like basically in freezing temperatures or below freezing temperatures, like ridiculously hard to do. But if you're able to do it, you get to at room temperature, the application becomes much more expansive, right? Now, that company was a seed stage company. We don't typically do it that early. But from a risk reward perspective, it made a lot of sense. We didn't have to write $10 million check into it in order to kind of see how it progresses. I was just saying, I think we always have this discussion internally about whether or not how much risk we should be taking, and should we be taking more binary risk versus just kind of, hey, this will exit to private equity, like for example, right? And so this is kind of what we, kind of settle on for now, which is some combination of the two is a good idea. Maybe you don't over-index too far one way, but you also don't over-index too far the other way. We're still fundamentally venture capitalists, early stage, and we should be taking more kind of risk.
So we all have our anti-portfolios, which, I think go all the way back, and I'd say everyone in LA that didn't invest in honey could put that on the yeah. Well, so we all saw it. Everyone saw it at some point, and we all thought that, a Google extension had no chance of being successful. So that was fun. That was a $5 million valuation when I looked at it. So that would have been fun. I'll go to sort of what we're looking at, and I think the bigger thing is the last 2 years. Pretty much any investment, 90% of the investments that we've made and would have made are facing troubles right now. Not because they're bad companies, because the valuations were out of whack. And ultimately in our industry, and kind of to your point about clutter, one of the challenges, especially as an early stage investor, and my previous fund, I was doing pre-seed and seed. So everything I was doing, I was either first check or very close to it, like $200,000 to $500,000 checks. And no matter how good the company does, if they can't continue to raise on a higher valuation and continue to grow, the earlier investors very often get screwed. So there's a lot of success that exists out there that we look at from an external perspective, and it's like, wow, what an incredible success. But you don't really necessarily know what the underlying nature of the early stage investors were. So like, if you didn't know anything about Clutter, I mean, he just whispered in my ear and he said, I didn't know Clutter got wiped out. And it's like, yeah, you would just see that Clutter is, still around, doing well. He's doing well in the sense of like the consumer perspective, but ultimately there's hundreds of millions of dollars that are now worth probably $30, right? And so, there's a long list of companies that live in that category. And in the last 2 years, there's going to be a handful that will continue to live over the next 5 years. So I don't really want to highlight on one. I just think there's going to be some pain, and we are currently facing that. I have, 90 portfolio companies over the last 10 years, and luckily a good portion of them are well capitalized and really thought about their unit economics and the fundamentals of their business so that they weren't reliant on raising serious capital in this environment. And so they're going to hopefully be able to get out and right size the business in a way that will prevent any major pain points. But I think for everyone here who's looking at the earliest stage, which is what I spent a large portion of my career looking at. And now we do like a little bit of later seed stuff, but mostly Series A. I think the most important thing is understanding, like, do you believe this founder has a strong grasp of the fundamentals to build a business while simultaneously having an outcome that is potentially binary, right? And it's a very hard balance because there's this balance of, is this person too conservative because then it's not a venture deal? Versus, are they, going to blow all your money and have to raise and is it capital intensive to a point where it doesn't necessarily pencil in an environment which is going to, at some point, which we'll call it Series A, is going to judge them based on their revenues and based on their actual economics. And so now, we have a handful of companies that might have raised at $100 million valuation 18 months ago are going out for 25, 30 because they raised on, 2 million of revenue and now they're at 6, but that 6 is getting valued at 6 or 7x, not 100x.
So a couple of deals. So on the core fund side, we led a seed round about creeping on 2 years ago in a company called Prepared, which the founder was a young guy. I think he was a sophomore at Princeton when he started the company. Just looking at the connectivity between 911 operation centers and cell phones, which until Prepared came along just didn't exist. If you were in an area and you had a cell phone and you had an emergency, it was this really ridiculous process to get you actually get you help. Launched the business. We led the seed round based on just what seemed like a very clear concept. Very young founder, but really highly skilled and very intelligent. That one's gone great. Andreessen's leading the Series B, like a $40 million Series B. So that's one we really like, right? High quality founder, interesting space, clear path to revenue. On the studio side, we sort of going the other way. We started a build with Tony Robbins. Tony Robbins was launching a book called Life Force around sort of biohacking and life optimization long term. He's an LP in the fund. We started talking about this concept. We built a business around it very quickly. I think 9-10 months post launch was at $12 million ARR. They've now raised a Series A as well. So sort of one from the founder side and one from really the incubation side. One that we missed recently on the venture studio, which is really unfortunate because it was really just sitting right in our hand and we could have had it. Two of the former lead game developers for Scopely left to build a casual games business. Sort of that micro snacking trend that we all had with Wordle for a little while. And they were just like, we can build these games using AI to build them faster, more efficiently, and make them more engaging. We had sort of a good 2 months of conversation just because we were kind of like, are we really just going to build like a mini games website? It just felt so 20 years ago. And they've already raised a ton of money and they're off to the races. They're doing a great job. So that's one we missed.
Are there any specific industries or segment within where your focus is that you're particularly excited about or avoid?
Sure. So as a fund, we invest very broadly behind 4 big themes: future of health, future of commerce, future of work, et cetera. So we don't have a very narrow lens. You can't avoid AI as just a core piece of almost any thesis at this point. It's eating the world, and it's tough to really find any pitches that don't have an AI angle in it. I would say that we are unlike where Rick's headed. We're not deep down sort of the frontier tech, hardware, quantum computing like Howard. Like, we're really more focused on sort of the enablement layer underneath the consumer layer for most of these businesses. So that's really where we're focusing. I would say, like, from an excitement perspective, anything where we're seeing, massive workflow improvements for efficiency within any layer above it is really a place where we're investing heavily. I think we did 3 AI agent investments in the past 6 months. And so that's really a heavy area of focus for the fund.
I'm not a generalist anymore, as fun as that was, but within our space is fairly broad within the built world tech environment. It's, as I said, it's sort of the life cycle of the building. So everything from construction all the way through. One of the things I'm interested in is actually the repurposing of assets. Where I think we're going to avoid for a little while are the capital intensive businesses, specifically around transactions. They're, in a low interest environment or zero interest environment, a lot of companies were built because they had free money, and there was a lot of business models. Some are surprisingly holding on like a firm, but there's a handful of business models that were created specifically in our space that were built around this concept of really cheap money. And I think we're going to avoid that, because I don't know if that's ever coming back to even close to what it was before. And so moving forward, I'd say some of our focus is around sustainability, because that's one of the low-hanging fruits of our customer base, and the customer base being anyone who is purchasing software or hardware in some cases, building owners, operators, and tenants. That's a huge topic, is sustainability, and it's a very broad one. So it's everything from how do we think about our utilities, how do we think about repurposing our spaces, making our spaces more efficient, how do we build in a more efficient way, because that's a huge part of the emissions in our space. And to your point about AI, it's obviously just sort of a layer on top. I don't even look at it as a vertical. That's horizontal. So yeah, that's big ones for us.
We probably are trying to avoid actually AI to some degree. Part of it is that there's a lot of kind of AI that's called a wrapper, and many of you probably heard of the nomenclature, where 97% of them, right? And what we do focus on there, though, is, do you actually have kind of a data mode coming in? Do you have a unique access or creation of data that nobody else has? Because if you're just accessing data using kind of publicly available LLM, you can do it in 2 weeks, so can the next guy, right? And then the secondary to that is, do you have a compounding mode from the data that you have access to and you're iterating on? So that's why I say, like, we actually to some extent avoid AI in a large degree, just because a lot of the companies we see, really don't have that, and you see a lot of it. I think it's just more of a funnel perspective. You still see, I think really interesting kind of players, new companies kind of going into that. But a lot of it is, if you just look at it through that filter, I think 90+% of it kind of falls out. Now, from an area that we kind of really, at least I'm looking at a lot, is production automation and the whole nearshoring and re-onshoring of infrastructure capacity, or just supply chain kind of within kind of Western countries. Global supply chains were fairly fragile, as everybody kind of figured out over the past kind of couple of years, and geopolitics has probably made this even much more of a thing over the next 5 to 10 years. So we're looking at a lot of that, and not just from an aerospace and defense perspective, but simply like, let's say, reclamation of lithium, right? Do you have access to lithium for battery technology, right? Iron ore, right? I just looked at a company that was doing, I said green steel, right? How do you take low grade iron ore and actually process it without being, having access to higher grade iron ore outside the United States? Stuff like that. But that's just like one aspect of it. But it's simply like manufacturing, industrial operations. How do you make that more efficient so that, we have a problem with labor in the United States. We're pretty much at full labor capacity, right? Believe it or not, this time around, the blue collar workers aren't the one that is actually getting hit the hardest. The white collar workers are actually the biggest problem. Got hit hardest. You can't find blue collar worker kind of right now. You see it all the time in your fast food restaurants down to the construction sites. It's actually really, really difficult to find that type of labor. And in order for that to get resolved, we're going to have to figure out how to be more efficient and work with what we got, which is a lower labor force that requires automation to be able to kind of make it more efficient. So that's what we're looking at.
So we've been generalist funds, I mentioned, for about 16 years at Crosscut, but the last couple of years I went from climate curious to climate committed because I read some books and realized that, the planet really is effed, and technology is going to be needed to correct that. But you also have 90% of the Fortune 500 committed to carbon neutrality by 2050. There's just a whole bunch of things happening. In some ways, it's the size of the industrial revolution at the speed of the internet revolution. I think that's what we're going to see over the next 5 to 15 years. So I thought I was sort of narrowing my focus as a journalist for such a long time. And I realized that when I said climate, it now encompasses it's almost like AI. A lot of things can be climate, but we've looked at electric airplanes. We've looked at electric train cars. You can take a single car, put it on the track, and send it from LA to San Diego by itself. 97% of train tracks are not used most of the time. So there's just a whole variety of things. We have invested in a new type of wind turbine. Doesn't look like a windmill. It's a whole different kind of thing. We think we can produce electricity cheaper than any other source in the world if it works. We don't know if it works. But we did just get $7.5 million committed. Not final approval yet, but from the state of Wyoming, a matching grant. We're invested in that with Bill Gates' fund, Breakthrough Energy, and a firm called Lower Carbon, one of the leaders in the space. So, I think overall we're looking at ways to keep more carbon dioxide from going in the atmosphere and the stuff that is there, trying to get it out, and that also implies electrification of America. Like everything is, your gas grill is not going to be there in 20 years. Your gas-powered water heater, and it's not hot water heater. My dad was a plumber. Water heater. If it was hot water, you wouldn't need to heat it. All that stuff's going to be write that down. All that stuff's going to be replaced, which means the grid needs to be improved. And we have these smart meters at the end of the grid at our homes, but that information is not being fed back to the utilities, who could use that to have a more efficient and effective grid. So climate, it covers a lot of things. It really is the reindustrialization of America, which is what A16Z calls their fund, something like that.
Can you each talk a little bit about where do you look to find deals? How often do you co-invest with other VCs? And what do you look for when you actually do a co-invest?
We get deals from a variety of sources. I will tell you this, in 27 years of doing this, I think I've done one deal that came in cold out of 20 or 30,000 that we've seen, right, that have come in over that time. So it really does help to have a deal come in from another VC. If Laurent calls me up and says, we're excited about this deal, 100% we're going to look at that deal. Morpheus calls us up, 100% we're going to look at that deal, right? So even John, show up. Even John, the new VC, definitely. Even John called up and said, "Yeah, we're definitely going to." So other VCs, our past CEOs, starting a company or knowing a company, our current CEOs referring deals in. So it really is you guys know all this, but it's a referral network. So there's a pile of deals that come in that way, and then there's the others. We're a seed stage fund, so 100% of the deals that we do, we look for co-investors. So it's, we are, I'm old school Silicon Valley in that way. I started investing in Silicon Valley in 97. That's just how you do it. You do it to lay off risk, but you also do it to bring other views to the table. And if things go well, you don't really need a co-investor. Most of the time they don't go well, or don't go as well in the time period you think. So it's nice to have deeper pockets and more experience and a different network around the table.
I think from a sourcing perspective, we kind of have both an inbound and outbound kind of aspect to it. Obviously, I think funds like Rick's with Crosscut and a lot of the kind of seed stage fund, pre-seed stage funds, their referrals are really valuable to us because it's effectively pre-vetted. They've done a lot of work. We know that the founders kind of already understand kind of what it takes to be a venture type company. So it really helps with kind of sophisticated investors who've done this before, kind of already in the companies. And obviously, we also have more of an outbound approach to it. I think we actually look at almost every deal that gets funded between $500,000 and $6 million kind of every week across the United States. When we actually go through that list and see which companies are, I think, interesting enough for us to kind of do outreach to and have and make contact and have a conversation. They may not be raising at the time. It's just kind of building the relationship kind of over the next weeks, months, or maybe sometimes years, type of thing. From a co-invest standpoint, we're fortunate enough to actually be co-investors with Laurent at JLL on one of our companies that we like a lot. And so it's an important aspect. I think the nice part about I think being in the LA ecosystem is that I think to a large degree you don't have as much sharper elbows. I think everybody's fund is not $3 billion. They don't have to take 95% of the rounds, in order to be attractive. So a lot of times we do team up. I think in terms of a lot of these type of rounds, and we always, we're believers in syndication, and we're always believers in making sure the previous rounds of investors always have their opportunity to take their pro rata to be able to kind of continue to support the companies. So we're very collaborative, kind of from that standpoint, and we've done so with a lot of the funds already in town on a number of different deals. So that's how we do it.
No, so I built my career off of trying to piggyback off of everyone else's success. And so, I became friends with Rick and realized that was a bad idea. But honestly, like when I first started, it's hard, especially when you're starting a brand, you have to get into the best deals and to be competitive, you have to provide value, one, but two, you often have to make concessions. And I found that the best success was when I was able to work effectively with other funds and work together to actually help build not only like momentum, which I think is a huge part of this. Sometimes the more great people around the table, more eyeballs you're going to get for momentum on a business, which is unfortunately, but realistically a large part of our job.
So M13 does what everybody else does. I think there's probably two things that we do that are relatively unique in the way that we source deals and execute deals. The first is, and this was shocking to me when I joined the firm, we throw events almost every other day. Like M13 is throwing a dinner, a summit, a party, co-hosting an event. It is insane. We have a full team. Their full-time job is to do events. And I've not seen it before in other funds. It's kind of an amazingly unique piece of what we do. And it's all just about creating value for the community. We do them in New York and in LA primarily. We have an office in New York. It's about a third of the firm. LA is a little bit more than half. And then we also have some full-time folks now in the Valley as well. And so the event side is really about bringing smart people together, get great conversation happening, introduce companies, introduce founders, and then just sort of let that percolate in the world and let the good things that come out of that come out of that. The second is just a very disciplined and very, I would call it, analytically driven sort of downstream and upstream approach to making sure that we have the right relationships with the right investors. It is because we are bi-coastal, because we're in multiple cities, and we're not just an LA fund, there's just a whole lot of coordination that has to happen around who has the relationships where, making sure that coordination sticks together. For the venture studio, we're relatively new at this. I joined, like I said, about a year and a half ago. We've been doing this work for about a year. It's a little bit different. We're trying to get to people who might start a company. I have this whole thesis on people that I call founders in waiting, who are people who would be amazing founders, but they just haven't started a business yet because of life. Whatever it is, they got a kid in a mortgage, or the job, the golden handcuffs of the current job, or they're a celebrity or a corporate and they just don't know how to build or they don't have the time. Whatever it is, they could be great founders and they just haven't gotten to that point. Let us do that first 6 months, 3 months, year of research to get you something that isn't you quitting your job, making $0 and hoping that your thing in the garage works.
Thanks everyone for listening. Really appreciate it. Catch us on the next one. Subscribe to our Substack. Looking forward to it.